Let's have a quick recap then about corporate governance. There's two basic approaches, isn't there? There's the comply or explain approach, or the principles approach, and then there's of course the legislative or the rules approach. Okay, so very quickly, quick reminder, with the comply or explain then, what you're going to have is you're going to have some regulatory authority, such as the stock exchange or whatever it might be, principles, okay, applying to PLCs. And what I want to make sure that you understand is that this compliance with these principles is expected, okay? It's very rare for you not to comply, okay? So if not, then what you must do is you must clearly explain, clearly disclose and explain why not. Okay, but that is not the norm. All right. Legislative then, obviously corporate governance set by law. All right. Now, both of these approaches then, they all deal with things like having a balanced board, thinking of having lots of NEDs, having a mixture of skills and experience. They also talk about how you would choose your executive directors, how you would appoint them, how you would remunerate your executive directors. They would say things like, look, it's really important to have audit committees because of their independence mainly. It's really important that you monitor your internal controls and that everything is disclosed, your corporate governance is disclosed in your annual report. Okay, that's the general idea, and I'll be moving on next to having a look at some of the principles. So let's have a look at that. Some of the principles that are involved in good corporate governance. Okay, now the idea is that we're going to have good leadership, and you have good leadership really by having an effective board. So what we want is clear responsibilities. Everybody knows who is responsible for what. So clear responsibilities. You've got to have a good mix of power and authority. What we mean by that is you don't want too much power in one person's hand. Have a good balance, okay? Again, it's all to do with things being effective. In terms of non-executive directors, well, what they've got to do, their job is to challenge the executive directors, to challenge the board, to help with strategy, okay, and to make sure that there's no domination of the board by either individuals or by a clique of directors getting together. In terms of board effectiveness then, you're looking for a nice mix, a nice blend of skills and experience at all times. You're definitely looking for some independence, some non-executive directors on there. You're looking for formal, transparent procedures, and particularly transparent procedures for things like appointment of board members. You don't want to just be appointing your friends, because you want the board to be effective. You're doing this on behalf of the shareholders. Okay, so you need really good board members. And really good board members comes from good induction, good training, updating of knowledge. So updating of the director's knowledge. In terms of accountability, well, you want to put a business review. The board needs to be accountable to the shareholders. So put a business review in the director's report. How well is the business actually doing? Make sure that you've got great risk management and internal controls, making sure that you're accountable for everything. Have formal procedures. Formal procedures for the external auditor relationship. Okay, in terms of remuneration, enough to attract, retain, and keep them happy, motivate them. Okay, just enough, no more than necessary. It's the shareholders' money that you're spending, no more than necessary to get the people that you want. Okay, and have a significant proportion of the pay on performance-related pay, or at least something that reduces the agency. So you're going in the same way, or the directors are going in the same way as the shareholders in terms of their goals. Talking of that then, shareholder relationships, you need a satisfactory dialogue. They need to know what's going on, not too much, satisfactory for them. Okay, obviously, one of the main ways you're going to talk to them is at the annual general meeting, but you must always encourage shareholder participation. It is their company after all. Okay, moving on then to audit committees. Membership. In the UK, we have this thing where it's at least 3 NEDs, and one of them must have relevant and recent FR knowledge. So relevant and recent FR knowledge. But obviously, ideally you're looking for all the audit committee really to be non-executive directors. The audit committee should review the financial statements and any other published information. Okay, and what they're trying to do when they're reviewing it, they're saying, is it true? Is it fair? Does it show integrity? Monitor the financial statements' integrity. How are they going to do that? Well, they're going to look at all the significant judgments that have been made by directors. Okay, review the significant judgments. What they've also got to do is scrutinise, question, challenge. This is the audit committee, remember, the finance directors and the external auditors. Make sure that, remember, they're independent. They're independent of the board and they're independent of the auditors. Make use of that. Scrutinise, question, challenge. Audit committees, obviously, systems and controls is important, so they want to review the internal controls and the risk management. They want to monitor the internal audit, make sure that they're doing their job. Not only are they doing their job, but do we really need to be spending money on them? So consider annually the need for internal audit, both if you have it and if you haven't got it. Okay, and then if you haven't got it, explain why no internal audit. Where would you explain it? In the annual report. Okay, and then finally, in terms of fraud, the audit committee have a job to do, and that's having a whistleblower facility. All right, so somebody can, particularly regarding financial reporting, an employee can say, look, one of the directors is committing fraud in one way or the other. Okay, so that's that for now. In the next video, I'm going to have a look at how the external auditors and the audit committee work together.